It's been a tale of two worlds. We're seeing economic growth coming under pressure in the US. We've got the Greek debt crisis, which is a massive overhang on a global level. And then we've got Chinese growth, which some say could experience a soft landing. We've got Nurul Rubini saying that it could experience a hard landing. Where do you stand on this, and how is it shaping your thinking when it comes to strategy?
Good afternoon, Eleni. That has been one of our biggest concerns, the second, third and fourth quarters of this year, where we believed that the biggest risk was to growth being downgraded globally, and this appears to be happening. Definitely what helped it along with the catalyst at this point in time has certainly been the Greek debt crisis. I don't think the Chinese circumstances are going to do anything to help the world growth, and one of our biggest concerns were that too many people were relying on that, and we do think that it's going to be a little harder than most economists had forecast a couple of months ago. So definitely we are very wary, and I am a little concerned as to where we're going to be going in terms of growth levels globally. And obviously it's going to affect South Africa as well.
Okay, you're talking about being worried and perhaps the growth trajectory that once economists had said the recession was over is not going to be as fantastic as anticipated. Are you expecting just a soft patch? Is it a double dip scenario that we're going to be seeing? Is the end of quantitative easing going to pull us back into recession? Is a Greek type default going to result in what we saw after Lehman Brothers collapsed? What are you pricing in as a possible scenario?
I think a little bit of everything is just going to exacerbate the situation. So the end of quantitative easing certainly not going to help us along. Quantitative easing in itself is exactly a replication of what got us into this mess in the first place. So unscrambling that egg is going to be difficult. Greece is going to certainly have a domino effect on some other countries in Europe, and then I'd be particularly concerned about the likes of Portugal, Spain, and even Italy. So I think that their debt levels are way above the levels that they should be. So what does that translate into? And effectively what that does mean is that the euro and the dollar relative to the rand should underperform. So I see in terms of South Africa, the rand appreciating relative to those currencies at least. So there should be some kind of underpin for us in terms of inflation, because imported inflation should not be a problem going forward. And I'm looking at the oil price, which we're still particularly bullish on. We anticipate the oil price climbing higher again, but with a stronger rand, it should buffer us against the negative effects of inflation.
Well, Kimon, I know where you're headed with this, because I know that you are a very big fan of inflation-linked bonds. Given the scenario that Jill Marcus has painted, our Reserve Bank governor, that we're only going to breach the 3 to 6% target band in the first quarter of next year, and it's only going to be a brief breach, how does that change your investment thinking? Are you still expecting inflation to come to the fore to South Africa once we do see that currency weakening off the levels that we've seen of around the mid-650s?
To answer your question, to a lesser extent, yes, but I think the inflation impact that most concerns us really are the effects of the oil price in South Africa and food inflation. Food inflation is something that no Reserve Bank or central bank in the world can do anything about. So it's about a scarce resource. So there I'd be a little concerned about inflation, but in terms of manufacturing and industrial inflation, we will have some higher levels of inflation due to the materials that have appreciated in value, but to a much lesser extent. What does that translate into when looking at an investment portfolio? I really do still like inflation-linked bonds. I still do believe that a portfolio shouldn't have less than 20% in inflation linkers. And inflation linkers in themselves offer a yield above the rate of inflation. So I think that's very important for investors to know. And therefore I would still like to hold them. So even if the inflation rate is around about 5%, the yield that one would be earning in excess of that would be roughly in the region of 2 percentage points above that.
Well, it's fascinating because at the beginning of the month we actually saw the 10-year break-even rates, and of course I'm alluding to the yield difference between inflation-linked bonds and fixed interest securities. That going up to around 5.7%. Do you expect that level to increase going forward? Are you expecting a bigger spread?
Well, look, if I do believe in investing in bonds, and I think it's the prudent thing to do. In the South African context, I'm much happier owning. I'd be much happier owning South African government bonds than government bonds from another country, especially Greece. But in
Come on,
particular,
Kimon,
I
you're
think
Greek. You're supposed to be supporting Greece as well.
Yes, I'd like to be, but I've also believed that we have to be realistic. And it does appear that they're going to be in a much bigger problem than what we will be. And if you have a look at well, in particular, 2-year Greek debt is in excess of 20%, and that's a huge yield in euro terms, but the likelihood of a Greek collapse is very high, and therefore that's why we aren't seeing investors rushing in to go and buy those bonds. But to answer your question relative to South African bonds, I do like the short end of the yield curve. I think that's where I'd be invested. So I wouldn't be buying bonds much in excess of 7 or 8 years. In fact, I'd like to go even a little shorter than that, and those yields would be sufficient for me. Now, one of the reasons I like bonds in general is that on balance, assuming there's no default, what happens is you get all your capital back plus whatever interest rate is payable along that. And if we look at the credit rating of South Africa, I certainly, and the ability of South African to pay off their bonds, they're a much better investment than some of the other asset classes.
Kimon, you alluded to earlier that inflation-linked bonds, of course, a fantastic product to look at in this environment, but talking about allocation of around 20% being the maximum, if I'm not mistaken. What about the likes of equities and other asset classes? What are you looking at now in terms of your portfolio and asset allocation?
Hasn't changed much. We were pretty defensive anyway. I wouldn't like to have anything in excess of 50% in the equity market. And even within that portfolio, I'd go for pretty much defensive stocks. As you know, we've avoided banks for almost 2 years now. I still think one should still avoid them. I think the banks are going to be under pressure. Part of the reason we're not going to see economic growth is because banks are not lending money. And there's a big problem in that because they're trying to shore up their balance sheets. European banks are pretty much exposed to Greece and other countries, and therefore the risks of any kind of failure by any of those countries would have negative impact on the banking system and the banks in Europe, which we would have at least a knock-on effect here. We've also got Basel III coming up, which puts certain restrictions on banks for their capital requirements, and again, that will prohibit banks from excessive lending, and that's not going to help any kind of economic growth going forward. So again, if one looks at an entire portfolio, I still do believe one should have between 5 and 10% in gold as a physical asset. I wouldn't prefer physical gold to any gold shares. And again, it's for the other reason being a currency diversification tool, and it's actually a real asset. Gold performance over the past 20, 30 years has been spectacular relative.
Kimon, in terms of emerging markets versus the developed market scenario that is playing out, because at the end of the day, if developed markets this year so far have done far better than the emerging market space, and one only has to look at the Shanghai Composite to see how much investors have liquidated their positions there. Where do you put your money right now? Is the safe bet still on emerging markets? Because we need to differentiate between the economy and what we see on the actual equity market.
Well, I think one has to be very careful. I wouldn't be rushing out and investing in all other emerging markets. I think the world in general is going to be on a downward trajectory or a plateau at best in terms of economic growth, and that would certainly have a negative impact on emerging markets. I've advocated us keeping our money here in South Africa. I think I'd rather invest here than many other countries in the world. Perhaps have a little stab at our neighbors and maybe make some minor investments there. But emerging markets in general are certainly also going to be impacted negatively with what we're seeing from growth levels. If you look at the so-called developed markets, one has to also take into account the relative, if you're looking at the US, for example, some people are saying, well, the US has had a great year. Well, it actually hasn't. It's actually down. But not only that, you would also be losing on your dollar investment. So the dollar hasn't done particularly well. The Dow hasn't done particularly well. So I wouldn't be rushing out to take my money offshore.